If you're watching this and you're panicking right now, I need you to stop, take a breath, and watch this entire video. Because what I'm about to show you doesn't make sense. The numbers don't add up. The story the market is telling you is not the real story. Over the last 24 hours, $15 trillion was wiped out from gold and silver markets. That's half of US GDP. Gone in a single day. Yes, silver dropped 38% in the last 24 hours. One of the biggest single-day crashes in years. And yet, at this exact moment, you cannot buy physical silver. The Perth Mint in Australia has suspended sales. The US Mint has suspended sales. The Royal Mint in the UK is out of stock. Dealers in India are defaulting on deliveries. Costco has put purchase limits in place. Let me say that again so it sinks in. The price is crashing, but you cannot buy the product. Does that make sense to you? In any normal market, when price crashes, supply increases, sellers show up, product becomes available. That's how markets work. But that's not what's happening here. Here, the price is crashing while supply is disappearing. The price is dropping while the entire world is running out of inventory. Something is very wrong. And by the end of this video, you'll understand exactly what it is. This is Joni AG, and welcome to the Exposure Index. If you're new here, I expose what's really happening in markets while everyone else gets distracted by headlines. Subscribe right now, because you won't find this kind of analysis anywhere else. And if this video helps you, hit the like button, because it helps the algorithm show this to more people who need to see it. Quick disclaimer, this content is educational and informational. It is not a recommendation to buy or sell. Do your own research. Now let me explain why today's crash is not what it looks like. A few days ago, I posted a video showing a key zone for silver. I explained why, after the run-up, a crash was likely. I showed a 30-year historical pattern. At the time, everyone was bullish. And now here we are. Silver dropped from 121 to 84. But here's what I didn't expect. I didn't expect that while silver was crashing, the physical market would break. I didn't expect mints all over the world to suspend sales. I didn't expect a total disconnect between paper and physical. And that's what we need to talk about. I'm going to show you what's happening behind the curtain. Pay attention, because understanding this could keep you from making a massive mistake. How the silver market really works. Most people don't understand this, and that misunderstanding is costing them money. There are two silver markets, not one, two, and they're telling completely different stories right now. First, the paper market. This is COMEX, futures, derivatives, digital silver. This is where hedge funds, banks, and institutions trade billions every day. But here's the key. They are not trading real silver, they're trading paper promises. Contracts that say someone will deliver silver in the future. Most of these contracts never turn into delivery. They're bets, casino chips, financial instruments with no metal behind them. The paper market is a giant poker game. Billions change hands, but almost nobody ever sees, touches, or holds a real ounce of silver. Second, the physical market. This is real metal, coins, bars, what exists in the real world. And here's the critical point. These two markets are supposed to be connected. The paper price is supposed to reflect what physical silver is actually worth, but right now they're disconnected. The link is broken. Paper says $84. Physical says none at any price. One of them is lying to you. Do you believe the screen or the empty shelves? The proof. Mints shutting the world down. Perth Mint in Australia. One of the biggest and most respected mints on earth. They've produced gold and silver for over a century. Governments trust them. Institutions trust them. Retail trusts them. On Thursday morning before the crash, when silver was still around 117, they sent a notice to wholesale distributors. I saw this notice. And it basically said, due to increasing worldwide demand for silver bullion products, we have a large backlog of orders for the 2026 Kangaroo 1-ounce silver bullion coin. As a result, we've decided to pause wholesale orders for this coin from today until February 23rd to clear back orders. Read that again. Demand increasing, not decreasing. Backlog, not excess inventory. Pausing orders, not running a discount sale, until February 23rd, almost a full month. And they also mentioned monthly allocations to ensure all regions receive stock. Monthly allocations, that's rationing language. That's what you do when you don't have enough product to meet demand. This isn't a bad day. This isn't a website glitch. This is the Australian government mint telling the world they can't keep up with physical silver demand, and Australia is a major silver producing nation, and their own mint can't keep up. Let that sink in. Then the crash hit. Silver fell from 117 to 95, a discount of over 20% in days. Now think logically. If the Perth Mint was already breaking under demand at 117, What do you think happened when silver crashed to 95? Smart investors saw a massive discount on an asset mints can't keep in stock. What did they do? They bought. They bought everything they could find. The crash didn't reduce demand. It created a wave. U.S. Mint in the United States. The U.S. Mint suspended sales of silver numismatic products. On the site, many items show temporarily unavailable. When you call, they say we're updating pricing. But what happened is simple. Price moved so fast they couldn't keep up. They were selling silver eagles at a price that became outdated, and they started losing money on each sale. So they stopped. They suspended everything. And when some products came back online, the price jumped sharply. The kind of overnight repricing. The 2026 American Silver Eagle, originally planned for January, was pushed to late February. Subscriptions already sold out. That's the official U.S. government mint telling you we can't sell silver at the old prices, and we don't have enough inventory to normalize the way you'd expect. India. Delivery defaults. India is one of the biggest silver markets in the world. And the issue now isn't just low inventory, it's default. Dealers taking orders, taking payment, and not delivering. People paying and not receiving metal. That's not a minor supply issue. That's a breakdown in the physical delivery system. Royal Mint in the UK. The official mint of the United Kingdom, one of the oldest mints on Earth, out of stock on silver bars, even 1 kilogram bars, the most basic format. When sovereign mints across different continents, Perth, the US, the UK, all face the same problem at the same time, that's not coincidence. That's not bad luck. That's a systemic crisis. And then the surreal one, Costco. Yes, Costco, the place you buy toilet paper and rotisserie chicken, sells silver. And they put purchase limits in place. Costco is rationing silver. Let that sink in. A retailer known for selling in bulk is now limiting how much metal you can buy. Why? Because demand is overwhelming supply. China, the data that should scare you. Physical silver in Shanghai is trading at $122. Not 95, not 84, 122. Now here's the part that should genuinely scare you. I have today's Shanghai Futures Exchange data, January 30th. The SHFE-linked vaults hold around 455 metric tons of silver, about 14.6 million ounces. Sounds like a lot? It isn't. And here's the number that made my jaw drop. In a single day, 26.94 metric tons were removed from the vaults, almost 27 tons in one day. That's roughly 870,000 ounces removed in 24 hours from one exchange. At that drain rate, Shanghai vaults could be empty in less than 3 weeks. For context, annual global silver demand is over 1 billion ounces, and Shanghai is sitting on 14.6 million, barely over 1% of annual demand. It's almost nothing. And mainstream media isn't talking about it. Now add this. China has already restricted silver exports. They've classified silver as a strategic national security asset, treating it like rare earths and critical materials. So think about what China is doing. Restricting exports, silver doesn't leave. Draining its own vaults. Moving metal from public warehouses into private storage. What does that tell you? It tells you China knows something you don't. While paper price crashes, China is pulling physical metal out of the system. While the West sells contrast, China takes delivery. One side sells paper, the other side hoards metal. Which side understands what silver is really worth? Who's doing the selling? The pattern that exposes everything. Now the most important part. Nearly all aggressive selling this week happened during U.S. market hours. Not Asian hours, not European hours, U.S. hours. When New York opens and COMEX begins trading. When New York opens, silver dumps. Red candles, aggressive selling. When New York closes, silver stabilizes. Sometimes it even rises in Asia. Then New York opens again and it starts again. This repeated every day. That's not random. That's a pattern. The U.S. dumps derivatives and digital promises. The rest of the world buys and accumulates physical. Stop and really think about that. American banks sell what they don't have, creating digital silver with keystrokes. Meanwhile, in Asia and the Middle East, people are loading bars onto trucks. One side plays a video game, the other side takes the prize home. And this disconnect has never been this extreme. This isn't a free market, it's a rigged game. And if you don't understand the game, you become the victim. You sell physical at the bottom because the screen scared you, and someone in Shanghai or Dubai happily buys it from you. Don't be the victim. Be the one who understands. Lease rates, the panic thermometer. Lease rates are what it costs to borrow physical silver. In normal markets, it's near zero, around 0.3 to 0.5%. Now rates have exploded. There are reports of 8% and even extreme numbers like 39%, depending on the snapshot. 39% to borrow silver. That's panic. Let me explain why this matters so much. Lease rates reveal the true tightness in the physical market. When a bank or mining company needs physical silver to fulfill a contract or delivery, they can borrow from someone who has it. Normally, this costs almost nothing because there's abundant supply available. But when rates jump to 8, 10, 20, 39%, it means there's no silver available. The few who have metal are demanding absurd premiums because they know it's scarce. Think of it like a thermometer. When it's at 0.5%, the market is healthy. There's supply. When it jumps to 8%, it's starting to tighten. When it hits 39%, the system is breaking. It's the financial equivalent of a high fever. It means something is fundamentally wrong. And these rates don't lie. They can't be manipulated like paper prices because they represent real transactions. Someone really needs metal. Someone really has metal. And they negotiate a price. When that price is 39% annualized, the market is screaming that physical silver is impossible to find. What this really means, no sugarcoating, what we're seeing is a collapse of the paper-based pricing mechanism. For decades, silver price has been set by paper trading. Banks trade hundreds of millions of paper ounces daily. Physical is tiny by comparison. That allowed suppression and control. But now something changed. Physical demand swallowed the system. Mints can't keep up. Vaults are draining. Dealers are defaulting. Lease rates are exploding. Paper says 95. Physical says none. Eventually, one of these gives. Either paper price rises to reflect physical reality, or the physical market breaks completely and paper becomes irrelevant. Let me give historical context because this has happened before. In March 2020, when COVID panic hit, paper silver fell to $12. But try to buy physical. Premiums exploded to $10, $15 per ounce. You were paying $25 to $27 for physical silver, while paper quoted $12. That disconnect lasted months. Mints couldn't produce fast enough. Dealers had backlogs of weeks. And what happened after? Paper eventually rose to reflect physical reality. Silver went to $30 in August. If you sold in March out of fear, you missed a 150% move. Another example, the Hunt brothers in 1979 and 80, they accumulated massive silver positions, bought physical and futures. Price exploded from $6 to $50. But here's the key point. It wasn't just the Hunts. It was global inflation fears. It was geopolitical instability. It was loss of confidence in fiat currency. The Hunts were the visible players, but the structural demand was real. And when COMEX changed the rules, when they forced liquidation, the price crashed, but the fundamentals didn't change overnight. What changed were the rules. The exchange intervened to break the squeeze. Today is different. Today, the buyers are sovereign nations. China buying for strategic reserves, India buying for cultural wealth preservation, industrial manufacturers buying for production needs. You can't margin call a country. You can't force a solar panel manufacturer to stop buying silver because they need it to make their product. I believe we're approaching that breaking point. And when it comes, it's not gradual. It's abrupt. It's forced. It's the market violently readjusting because the distortion got too large. What this means for you, practical. Understanding this is useless if you don't know how to act. So I'll be direct. If you hold physical silver, don't panic. Don't let paper price scare you into selling your metal. Look at the facts. Mints suspending sales, dealers not delivering, China hoarding, vaults draining, lease rates exploding, and you're holding the one thing the whole world is scrambling to get. Paper price is noise. Your metal is worth what someone will actually pay in the real world. And in many places, that's far above 95. More importantly, physical can't be force liquidated. If you have bars in the vault, nobody can margin call you. Nobody can force you to sell because price dropped. You decide when to sell. That's the power of holding the real asset versus a paper promise. If you hold paper silver, ETFs, futures, ask one question. If everyone demanded physical delivery tomorrow, could your counterparty deliver? Probably not. You don't own silver, you own a promise, and promises break. ETFs like SLV supposedly have silver in vaults, but they have clauses that allow cash settlement under certain conditions. Read the prospectus, it's there. If the system breaks, if there's a run for delivery, they can simply pay you in cash at market price. And if market price is being suppressed while physical is scarce, you're left with worthless paper while metal disappears. If you're trying to buy, good luck. Physical premiums are exploding. Paper says 84, but in the real world, your price may be 120, 130, or higher, depending on region. And here's the paradox. The lower paper price crashes, the faster physical disappears. Lower prices create more demand drains supply faster. The crash is making the shortage worse, not better. If you decide to buy physical now, here's what to do. 1. Diversify sources. Don't depend on one dealer. Don't assume one website will have stock. Check multiple. Compare premiums. And understand that high premiums now may be normal going forward. 2. Prioritize availability over price. If one dealer has in-stock shipping today at 120 and another has pre-order for February at 110, take the in-stock. Because in February, the pre-order may not come. Dealers may cancel because they can't source. Bird in hand beats two in the bush. 3. Consider different products. If Silver Eagles are unavailable, look at Canadian Maples. Look at Austrian Philharmonics. Look at generic bars. The silver inside is the same. Premium may vary, but metal is metal. 4. Don't leverage. If you buy physical, buy with money that can sit for years. Don't buy expecting to sell next week for profit. Physical is preservation, not speculation. Is this a conspiracy? No. It's evidence. Some people will call this a theory, so I'll answer. Look at the facts. Perth Mint suspended. U.S. Mint suspended and repriced. Royal Mint out of stock. India failing deliveries. Costco limiting purchases. Shanghai draining 27 tons in one day. Lease rates exploding. That's not one mint having a bad week. That's the planet all at once. Crash timing. Last Friday of the month. Not accidental. Today is Friday. End of week, end of month. Big moves love Fridays, especially end of month Fridays. Options expire. Futures settle. Positions get squared. Books get closed. The timing isn't random. January was historic for silver. Now, on the last day, they smash it. Scare retail. Shake weak hands out. That's how wealth transfers, from the emotional to the patient. Your fear becomes someone else's buying opportunity. The bigger picture, 5 years of deficits. This didn't start today. Silver has been in deficit for 5 straight years. Since 2021, demand has exceeded supply every year. The world mines around 835 million ounces per year, but consumes over 1 billion ounces. The gap is filled by draining above-ground stockpiles, vaults, reserves, old inventory. Think of a bathtub. Mine supply is water coming in. Demand is water going out. For 5 years, more water has drained out than came in. The tub is emptying. The cushion is gone. The buffer is disappearing. And now, with mints shutting down and dealers defaulting, you're seeing the consequence hit the surface. This doesn't fix itself next week. It's structural, and it's accelerating. What I think happens next? I believe we're entering a new phase. Paper and physical diverge more and more. Paper can stay volatile, crash, spike, and it will be manipulated as long as paper exists. But physical gets rarer. Premiums rise. Availability falls. Eventually, you simply can't buy physical at paper price. That's already happening, and the more physical disappears, the less credibility paper has. Let me be more specific about the scenarios I see. Scenario 1. Forced reconciliation. Paper price is forced to rise to meet physical price. This happens when large entities try to convert paper to physical and can't. When ETFs face redemption requests, they can't fulfill. When banks with short positions need to cover and there's no metal available. In this scenario, you see paper price rise violently to 120, 150, 200 as it tries to find a level where physical supply actually appears. Scenario 2. Two-tier system. Paper and physical become completely separate markets. Paper continues trading between 80 and 120, volatile, manipulated. Physical trades permanently at 30, 40, 50% premium above. You have a screen price and a real price, and the whole world knows they're different. In this scenario, serious buyers ignore paper completely. They only look at physical premiums and availability. Scenario 3. Paper breakdown. The exchange intervenes. They change margins. Force cash settlement instead of physical delivery. Change the rules to break the pressure. We saw this with nickel in London. The LME suspended trading, canceled trades, changed terms retroactively when a short position couldn't deliver. It can happen with silver, and if it does, it validates everything I'm saying. Proves the system can't function when physical demand exceeds paper. Which scenario is most likely? I don't know, but all three result in the same conclusion. Physical is worth more than paper says, and if you have physical, you have the real asset. If you have paper, you have a bet on a system that's breaking. Closing. There are three types of people watching this. The one panicking and wanting to sell. The one frozen because they don't know what to believe. The one who understands and uses this as an opportunity. Which one are you? Paper silver dropped 38% in 24 hours, and in that same window, Perth suspended, US Mint suspended, Royal ran out, India failed deliveries, China drained 27 tons, lease rates exploded, price went down, metal disappeared. One of those is a lie, and it isn't the empty vaults. This is what manipulation looks like. This is what a paper-physical divorce looks like. This is what happens when paper promises collide with physical reality. They dumped the price. The world ran out of metal, and you decide which side of that equation you want to be on. I'll keep bringing updates as this develops. Subscribe if you haven't. Turn on notifications so you don't miss what comes next. And comment below. Do you think paper wins or physical? Because I read every comment, and if enough people want it, I'll make that the next video. Remember what I said at the start. Price is crashing, but you can't buy the product. That's not a market. That's a magic trick. And now you know how the trick works. This is Johnny for the Exposure Index. If you liked this, hit like and subscribe so you don't miss the next update. See you in the next video.